Thank you to the Tecxposition team for having me. So I'm Adesuwa Okunbo Rhodes. I'm the founder of Aruwa Capital Management. I've been in finance and private equity and investment banking now for the last 12 years and spun out of my previous fund to launch Aruwa last year. And we are a growth equity and gender lens fund. So we invest in businesses, established rapidly growing businesses that are either catering, so providing goods and services and catering to what we believe is an untapped female economy, where a lot of the growth that's going to come from Africa is in internal consumption, and women are driving, 70 to 80% of those decisions. So we want to be investing in businesses catering to that market. And we're also investing in businesses that are either founded by women, led by women, have gender diverse teams, or have women active in their value chains, because we think that that is also going to be a real value driver for not only returns in our fund, but also helping to maximize social impact as well. So that's me.
Great. Evelyne, tell us a little bit about you and your company.
Thank you. I'm very happy to be here today, thanks to the organizing team. So my name is Evelyne Dioh. I am the managing director of WIC Capital, which is the first fund in the Francophone West Africa space to exclusively target women-led businesses. The fund was set up last year in 2019 by a group of 86 women in Senegal, the Women's Investment Club. And we exclusively target women-led businesses. We are sector agnostic. And we just started our investment during COVID. We did 2 investments so far. So looking forward to telling you more about it.
Great. I can't wait to hear that. And investing during this pandemic is not for the faint of heart. So we definitely want to get into that. Elizabeth Howard, tell us a little about you and your firm, please.
Thanks, Caleb. And thanks to Tecxposition for organizing this. So I wear a couple of hats. I am the founder of Lelapa, which is an African fintech advisory firm that houses a network called Women in African Investments, the WAY Group. And that's a sort of peer-to-peer learning network for female African investment and professionals. And Evelyne and Adesuwa are some of my favorite people who are in the group. And the other thing that I do is I'm acting CEO of the African Crowdfunding Association. And tomorrow I'll be giving another discussion around crowdfunding in Africa. And there's quite a big gender lens to that work too. So yeah, I'm very much dedicated to getting SMEs funded, and in particular women-led SMEs funded. And we really take an entrepreneurial lens to the problem. Originally, Lelapa was an equity crowdfunding platform in Kenya that focused on SMEs in the segment. And through that journey, we learned a lot about the problem that we're trying to solve, as you do. And that's kind of what led to starting the WAY Group and what led to starting the African Crowdfunding Association. So yeah, looking forward to speaking more about it.
So I don't need to tell you three or anybody listening here how challenging it is for anyone to access capital, but especially women in Africa. It's getting better, but it has been a challenge. And there's a lot of people who are unbanked, a lot of folks who don't have access to the credit market and don't have access to venture capital. That's improving a little bit. So just starting with you in terms of Elizabeth, starting with you and what you've been able to see over the last couple of years, how has that access to capital changed? And is it becoming easier for female entrepreneurs and female run businesses to tap into it for growth?
So it's a great question. And I think that we look at this problem and the evolution of progress at 2 levels, the access to capital of women entrepreneurs and the access to capital of women fund managers. When it comes to the access to capital of women entrepreneurs, things are improving in some regions, less so than others, because you do have a lot of, well, you have a consensus now amongst key development finance institutions that increasing the number of women-led SMEs in their portfolio to at least 40% is, not only right, but it's good for business. And there are a number of organizations that have signed up to the 2X challenge, which you might have heard about previously. It's just a commitment of a lot of DFIs towards women empowerment over the next few years, notably the related SCG. And so that's great. But the progress towards really sort of moving the needle is hampered by the fact that a lot of the intermediaries through which these organizations need to deploy their capital are not led by women, sort of less than 1% or something really very much sort of ridiculous. And that means that you've got to come up with creative solutions, and the DFIs that do commit to the 2X challenge actually are called to be more innovative in order to get capital flowing through women-led funds. And if you're running a fund like Adesuwa is, which is targeting sort of a larger deal size growth companies, you're faced with a set of challenges in the sense that there's just very, very few women-led funds. I think we know of 2 in Africa that have actually successfully closed. And they are in a sense to be a place that makes a lot of sense. So they're playing in a part of the market that is commercially viable. And then if you look at Evelyne's fund, they're targeting the smaller SMEs, and just moving down ticket creates a whole host of other problems for the economics of a fund. And before you even look at the gender lens, those problems are very significant and hard to solve on themselves. So we've got a long way to go, but the good news is that, there is a consensus now that we should actually be taking these things seriously. So I'll let the others.
Great response. Adesuwa, I want to turn to you because you did have some training at Lehman Brothers. You know what Wall Street investment banks are like. You know what big funding looks like and where it comes from and where it goes. What's so different in 2020 about raising capital right now? Where's the money coming from, and what kinds of questions do investors ask about the money, the companies you want to fund?
Yeah, no, I think that's a good question. So I think 2020 has definitely been a very difficult year for us as even the investors as well, not only the entrepreneurs. But I think that we're having to be a little bit more innovative in where we think about accessing capital. So for us as investors and also for entrepreneurs that we're also investing in, we've had to look inward. So trying to mobilize local capital, I think, has been a big theme this year, because a lot of the foreign institutional investors are, with COVID, optimizing their existing portfolios, reluctant to form new relationships where, borders are closed and you can't do your normal on-site due diligence, and building the trust of your new manager, that face-to-face contact is sometimes needed. So for us, it's really been about finding pockets of local commercial capital where we can, still execute on the deals and support the entrepreneurs that we thought were viable prior to COVID and are actually now thriving in this new normal because of our investment strategy, where it's, essential goods and services essentially. So I think that's really in terms of the pockets and the access to capital. Entrepreneurs are thinking about mobilizing local capital from high net worth individuals, from family offices, a lot of, saving rates. It's a very, very low interest rate environment right now, with inflation in Nigeria at close to 14% and saving rates at less than 1%. Investors are looking to diversify. They're looking to enhance their long-term investment portfolios. So they're really looking at alternatives very, very seriously. And since the summer, we've managed to raise, enough capital to be able to complete at least two investments before the end of the year from this pool. So that's what I've been saying to some of my other female GPs is, yes, the DFIs are great, but let's start looking inwards and seeing what we can raise. In terms of
we have all kinds of interesting people jumping into our chat, but we're going to hang with it. Evelyne, I want to move it to you because you actually raise money for the smaller businesses. Has the expectations in terms of your investors changed in terms of the outcomes they're looking for these small businesses? Is the capital patient, or are they wanting these companies to pivot given their investments and given the way the world has changed?
We are still fundraising. As Elizabeth mentioned, the challenge that a fund like ours faces is that we target small businesses. So we want to do small tickets. Our maximum ticket is $250,000 USD. And the investors we talk to are interested in reaching these businesses, but they see us as a really small fund because we do not aim at raising like a 50 million fund. We want to raise a 15 million USD fund in order for us to be able to deliver these small tickets, which are needed when you consider our target. These are small businesses, still early stage, but with a high growth potential. So the discussion is still, we have this dichotomy between the impact intended by these investors and what is actually feasible on the fields. And what we have here, like Adesuwa, we have also started targeting our local high net worth individuals and local corporates to form a first fund, because we think that the traditional investors, they need to see the results first. So we are going to start with this local capital. Anyway, we did our first investment with our own capital because it's an investment club to start with. It's a network of angels that have invested in Week Capital. So we are continuing this way, mobilizing local corporates, local insurance companies, individuals, and then we will be able then to move the discussion with investors, with more traditional investors.
And Elizabeth, I'll throw it back to you. Are there particular sectors that are more attractive for outside investors right now within Africa and female-led businesses where it's a much easier conversation in terms of raising that money, whether they're digitally enabled or they're providing a service that is much more essential given the pandemic today than it may have been a year ago?
Yeah, I think there are some parts of the capital markets that development finance institutions are comfortable with just by virtue of their experience in it. So you do see a lot of commitments to venture capital companies that are targeting high growth tech-enabled startups. And, you know, sort of Series B, Series C, and, you know, there's a whole debate about, you know, what role the DFI should be playing in that space. And I mentioned the DFIs a lot when I say that acronym for people who are on the call who don't know what it is. It's Development Finance Institution. I say it a lot because if you're trying to raise more than $20 million or even more than 10, you almost definitely need a DFI. And so they do decide sort of what gets funded and where. There's not necessarily a lot of women in that space. Sort of anecdotally, people who are confronted with the pipeline, people like Evelyne and Adesuwa, might realize that there are, you know, a lot of women in agribusiness, or by virtue of their career paths might find themselves in health and education. And also in just businesses that are not necessarily high growth, but certainly are very impactful on the job creation front. And, you know, just for whom the venture capital is unrealistic or it's undesirable, but for the entrepreneur, and also because of the pressures that it creates internally on companies. So, you know, there's a need for something other than venture capital, but there's not a lot of experience outside of, say, South Africa and maybe to a lesser extent East Africa on how to figure that out and how to do small deals. So, yeah, it kind of comes back to that point about the need for, you know, to really take seriously, first of all, these companies that are less sexy and take them seriously from an impact perspective. And then also take seriously the intermediaries that are facing that demand every single day and are working out how to build a fund structure that actually meets their needs.
Right. Adesuwa, let's come back to you for a second. You know, all venture capitalists, all investment bankers are looking for the exit strategy. They want to know what the end game is. You're trying to fund companies, and Evelyne too as well, that are, you know, want to be operating concerns and run their businesses and deliver returns. But in terms of that conversation, when it comes to what's the end game for a lot of these companies, how much pressure are you getting from investors and high net worth individuals who are willing to deploy capital but want to know what it's going to look like when it comes back?
Yeah, you know, that's always a question that we get from our investors in terms of, you know, how are we going to get our money back, and it's also something that's top of our mind as fund managers as well. And I think the beauty of the space that myself and Evelyne are in, it's an overlooked and underserved space. The majority of the private equity capital that's been raised for Africa is, you know, they're chasing the same deals. They're chasing the deals that are few and far between to find, you know, the deals in the 50 million, 20 million, you know, $100 million range. Those deals are harder to come by. Whereas the deals that are in the, below 5 million range, that's really the bread and butter of where the African economy is transacting. Specifically in the 500,000 to $3 million range, which is where we transact at Aruwa. So our exit strategy is very clear. We come into these businesses typically as the first institutional investor. We provide them with capital, but we also institutionalize them in terms of helping them improve their decision-making procedures, helping them improve corporate governance, and they become very attractive targets for those large private equity funds that are struggling to find good deals. And the reason for that is in Africa, I don't want to give a history on private equity in Africa, but in Africa, a lot of money was raised on the back of the Africa Rising narrative, where we kind of leapfrogged in terms of the supply of capital and not really thinking about the opportunity set that we have available in Africa. So, we have $1 billion funds, we have, $800 million funds, we have all these large funds in Africa. But, if you're thinking about a typical fund portfolio, they want to do between 10 to 15 investments, right? So they need to deploy at least 70 to 100 million into a single company. Where are we in Africa today? We don't have enough companies that can absorb that type of capital, right? So because of that dislocation that's happening in the private equity model for Africa, which personally I think is broken right now, we need funds like myself and funds like Evelyne that can actually provide the pool of readily investable companies for these larger PE funds to invest into. So our exit strategy is actually, it's a no-brainer. The exit strategy of those larger funds, those ones are a little bit more harder to understand for me, because trade sales only happen now and again because they're typically multinationals that are coming to buy these businesses. So we just don't have a deep enough market in Africa yet, which is why we need, early stage funds, VC funds that are operating in this more nimble space, so that we can create those readily investable companies for those larger private equity funds. So secondaries, I think, is going to be a major exit driver for the space that we're in, where we build these companies up to very, very attractive targets for larger private equity funds to swoop up.
Great. And then I'll stick with you for just a second, and anybody can jump in on this. You mentioned foreign capital. Are there regions or countries specifically that are much more hungry for these type of investments and have been more sort of on your speed dial than others? Are you seeing it coming from China, Europe, or is it Africa-centric?
In terms of investors coming into Africa, or coming in?
Yes, coming in.
So I would say that we're getting a lot of interest from the US. We get a lot of interest from Europe in terms of commercial investors that I'm speaking to, and then obviously you have your usual DFI suspects, which are typically European. But yeah, I think the world is finally waking up that the last frontier of growth is Africa. Where do you want to be putting your money in the next 50 years? It's Africa. This is where the population is going to be doubling. We have a rapidly urbanizing, growing young population that are going to need goods and services. So, where do you want to be putting your money if you're looking to create, generational wealth? I believe that it's in Africa, and every aspect of Africa. I focus on East Africa, on West Africa, but there are also pockets of, East Africa, North Africa that are very, very attractive as well from an investment perspective.
Sure. Evelyne, I'll come back to you on this. Let's talk about accelerator programs. Have you found them to be useful? I'm thinking about things like the Greenhouse Lab, She Leads Africa. Have these been able to help businesses get going, or been a successful network for those businesses that exist to share trade secrets or share strategy to try to grow and raise capital?
Yeah, they are playing their role. There's definitely a need for that, especially when you talk about some very small businesses, these early stage businesses that we target, and that are providing lots of jobs on the continent and that are key for the development of the continent. So for these businesses to be investment ready, they need to go through some acceleration program. For example, we are not working with the programs that you mentioned. I don't think they're active in Senegal or Cote d'Ivoire, in Francophone Africa. But at the Women Investment Club, we develop our own technical assistance facility, WIC Academy, that is preparing cohorts of 10 companies to be investment ready for our investment so that we are able to deploy capital quickly. I just wanted to comment on the question to Adesuwa regarding exit. Exit is a key problem to attract capital. This is a key question. There is a secondary market, but to be fair, we know that we have to structure deals differently. What we have started to do at WIC Capital is finance these businesses through self-liquidating instruments. We have used, we wanted for the last deal we made, we wanted to do a demand dividend, but we had some legal constraints. So we did a mix of ordinary shares, preferred shares, and shareholder debt. So that by the end of, by the time we exit, we are able to get 3 times our initial investment while letting to the company enough cash flow to reinvest in their growth. So this is, I think this is key. This is a way to go for if you want to invest in small businesses, so that both sides are happy, investors and enterprises and developments.
I'm going to take a question from the audience. Jenny wants to know, how do entrepreneurs get access to these funds or networks, especially those that have gone through accelerator programs? She's found it hard to get access to VC or funds interested in startups as a female founder. Now, there's obviously you folks, but just breaking through there, how do you get in? How do they break through if they're not on your radar? Let's start with you, Evelyne, and then we'll take it back to Adesuwa.
I'm not sure I understood the question. She already went through an acceleration program?
And she's having trouble getting access to funds or venture capital networks. Okay.
Because normally this acceleration program, the end game is to give these entrepreneurs access to capital, so they have their own repository of potential investors, angel investor networks that they could put her in touch with. Otherwise, she has to do lots of research. There's a lot of documentation online that she could find. Use LinkedIn to get in touch with investment professional directly that could redirect her to the right fund or the right network, because there's a lot of angel investing going on the continent right now that might be a right fit for her.
Great answer. Thank you for that. Elizabeth, if you could snap your fingers and change one regulation to make it easier for female entrepreneurs and businesses to access capital, what would it be?
I'm obviously going to plug the regulation that we've been trying to change for several years, which is around allowing a private company to raise capital publicly using its existing social media and other sort of public-facing accounts, and that's called crowdfunding. So yeah, a lot of African entrepreneurs do this anyway in some form or another. It just isn't necessarily formalized in the sense that it is plugged into capital markets that would enable that private company to go from crowdfunding to a fund like Evelyne's, or from an accelerator to crowdfunding, or it's not plugged in that way. And what the regulation actually does, it views what's happening on the ground, it formalizes it, and it connects the dots between, say, microfinance and private equity. It's also super useful for angel networks to just formalize their group fundraising, and could potentially, depending on the regulation, be useful for small funds like Evelyne's fund or similar that actually want to go to their local retail investors and sort of crowd invest or crowdfund their fund rather for sort of its first round. So that would be, that's something we are working on and really excited. There are a few bright spots across Africa. Definitely East Africa and Ghana are working really hard at that. Also the CEMAC region, so that's Central Africa. And hopefully 2021, we see some good action there.
Question from Raj. He likes the idea of self-liquidating instruments. Could you explain those further? Most startups tend to do vanilla pride rounds or safes or convertibles. Adesuwa, can you take that? Were you talking about self-liquidating, or was that Evelyne?
It was Evelyne talking about self-liquidating.
Oh, it was Evelyne. Well, you can both handle, but let's start with you.
Yeah, sure. So we also use self-liquidating instruments. So we tend to use prefs or convertibles or some element of mezz. Where we structure within that a buyback from the entrepreneur, or we have something that says, we can exit at an agreed valuation methodology that's already kind of agreed at closing. So, with a lot of entrepreneurs that are, in our segment anyway, where they're already established, they're rapidly growing, they just need incremental capital to unlock that next stage of growth. I always say to our investors, we're actually taking credit risk, but getting equity-like returns. So we can structure an instrument that is, structured as a mezz instrument where we can still generate 3x and be able to exit in 3 to 4 years. So yes, those self-liquidating structures are definitely. We also use that as well. So maybe Evelyne, you can also.
Yeah, Evelyne, on the smaller company scale, how does it work?
What we have done, we have structured something that is cash flow based, like taking a percentage of the cash flow, like after 2 years of investment, and making sure that by the end of we intend on remaining in the capital during 6 to 7 years, so that at year 6 or 7 we have generated 3 times our initial investments, so that we just give back the shares to the entrepreneur at a pre-agreed price, which is generally very low. So there is no credit risk, so to say, because the shares are cheap, but we have generated a super dividend for us, and there's still enough cash flow for the business to continue investing in its growth. This is one way to do it. It can also be done via a % of revenue. This is a revenue share model, the typical royalty model. So yeah, but we have done it. We have done it for one deal that has been closed and disbursed, and we are in the process of doing it for a third deal. So it's just a negotiation. It's just a negotiation process between the entrepreneur and us and our lawyers.
I'm going to throw the same question back to you that I asked Elizabeth. If you could change one regulation to make this a little easier, what would it be?
For us, we are locally incorporated, but because and we don't have a proper regulation around limited partnership. This structure doesn't exist in Francophone Africa. So if you are a fund, either you go incorporate yourself in Mauritius in order for you to be less exotic for traditional investors like DFIs, or you can incorporate locally and just be a normal company, like a holding company. And we chose to incorporate locally because of our story and what we want to do. We are discussing with our ministry, which is discussing with the other ministry in the Remy region, and we know that it's going to move in the next month, but we would love to have it very quickly so that once we have this structure, we can then move the fiscal regulation in order for us to generate more return and be more competitive towards investors.
Final question. We only have a couple of minutes left. I'll let each of you take it, and we'll start with you, Elizabeth. If you were an entrepreneur now, starting a business or considering starting a business, what sector would you gravitate towards where you know the capital's there, you know the opportunity's there, and it has the best long-term prospects given where we are now in 2020? Elizabeth, that's yours, and then we'll...
Yeah, so if I were starting a company in Africa, I probably shouldn't say this, but I wouldn't worry too much about the supply of capital, who's going to put money in it. I would make sure, first of all, that I'm deeply, deeply, deeply passionate and committed to my vision and what I want to do, because you're going to be sweating for the next 3 years anyway, and you got to stay in the game, and you need as much commitment, personal, deep commitment and motivation to that as possible. And yeah, I'm definitely a fan of sticking to your mission rather than twisting yourself into the shape of a fund who hasn't really thought about you or your company. They've been thinking about their own sort of commercial needs and politics and all the other things that fly around on the table when funds get formed in Europe and elsewhere.
Great. Adesuwa?
Yeah, so I'm a generalist, so investor, so I don't gravitate towards any one sector. But I'd say that the things that are exciting us right now that we're working on, We've seen some very interesting things in healthcare that are thriving in this new normal. We've seen some interesting things in e-learning that are really thriving during this new normal. And I would also say we've seen some interesting things in fintech. There are some interesting platforms that are using blockchain to enable cross-border payments between Africa and developed markets. And I think that's really going to also explode over time, specifically in places like Nigeria, where we have some of our own infrastructure and operational deficiencies when it comes to cross-border payments. So I would say that those are probably the sectors that are exciting me right now. Those are the sectors that we're prioritizing in our pipeline: financial technology, education, and healthcare.
Great. Evelyne, you get the last word on that.
If I was an entrepreneur, I would go to a more traditional sector. It would be the food and beverage industry, because we have so many superfoods on the continent that are underexploited by local people. So there is so much to do there. And so, yeah, definitely funding is available, expertise also. We just have to know how to go around it and get the right technical skills in your team to have something very flourishing.
Great, terrific. Adesuwa Okunbo Rhodes, Elizabeth Howard, Evelyne Dioh, thank you so much. Great panel. And I know you have your LinkedIn and your Twitter handles here and your contact info. I think folks really want to speak to you. So thanks so much for your time. And again, thanks to Tecxposition and Ify and her team for a great conference so far.
Great facilitation.
Thank you so much.
Hello.
Thank you. Thanks, guys. Bye.
Everyone.